everyone. Welcome to another riveting series in our webinars with Crow. My name is Sean Chia. I'm the Executive Director for the Malaysian International Chamber of Commerce and Industry. We are one of the oldest Chamber of Commerce in Malaysia, and it's one of our stuff that we want to share with all our members and the public at large on current events and policies and stuff that help your business. Transfer pricing is our topic this time round. And since 2009, with the introduction of the transfer pricing landscape, there's a lot of changes, and the business community has seen quite active changes in regulatory pressures, especially from the inland revenue in terms of collection and enforcement. So there are quite some transfer pricing changes effective from 1st of January 2021 that businesses must take cognizance of. And today we have Ms. Sylvia Song, the partner of Tax Crow Malaysia, to give us a little bit of insights in what businesses should be taking care in this new transfer pricing regimes. Sylvia is the tax partner of Crow Malaysia. She specializes in transfer pricing and leads a transfer price team in Crow, Kuala Lumpur. She has, of course, more than 12 years of experience in this tax environment, handling all manners of compliance, advisory, and tax planning, GST, and all indirect taxes. She services both local and multinational, so therefore she has a good wide breadth of how things work in the business world. So without further ado, I would like to introduce Sylvia. Sylvia, are you ready? I'll hand the floor to you. Sylvia?
Yes, sure, Sean. Thanks, Sean, for the introduction. Just let me share my screen.
Oh, okay. Just a slight housekeeping rule. Okay, so if those watching from Facebook, you can do messaging and we will push it through to the questions here. Okay. Sorry to interrupt. Over to you.
Okay. Yeah. Thanks, Sean. Okay. Good afternoon, ladies and gentlemen. Now is the lunch time. You can have your lunch bite while listening to me. I'm Sylvia, the speakers for today's webinar. Firstly, I would like to thank MICCI for inviting me to speak on this topic to brief you on the important updates on transfer pricing requirement in Malaysia for year 2021. Yeah, as you may aware that IRB has made several new changes to strengthen the enforcement of transfer pricing compliance in Malaysia, including making the transfer pricing documentations mandatory for companies undertaking related parties transactions. This is me. Yeah, I'm leading the transfer pricing divisions of Crow Malaysia. We have a specialized transfer pricing team based in KL, yeah, with more than 20 over full-time transfer pricing consultants providing full range of transfer pricing services. Crow Malaysia is the 5th largest accounting firm in Malaysia with 15 offices and over 1,300 employees. Okay, our transfer pricing team supports all offices within Malaysia. Not only that, our Crow Cambodia as well as regional transfer pricing matters. We do have our global network with over 200 members firms in more than 145 countries globally. So I will move on to the topics today. I will brief you through the key changes and the latest updates on transfer pricing, what is happening this year, and what is the IRB's looking towards, yeah, on the taxpayers. Although we have been under lockdown, yeah, since June, we are on a full MCO, but we have been receiving IRB audit letters yeah, on transfer pricing. They are very aggressive in carrying out audit, although during the FMCO period, the IRB office is closed and most of the IRB officers are working from home. They do send out audit letter as well. So we do face quite a number of audit cases carrying on, yeah, right now. So we have to be alert, yeah, on what is happening and what need to be complied with, yeah, the requirements in Malaysia. And the last sections will have a Q&A sections, yeah, with any one of you who wanted to post any questions to me or my team. Just feel free to post it at the chat box, yeah, or the live streaming, you can post it at the comment. So we will attend to that at the end of this section. I do receive some questions in advance during the registrations, and those questions will be attended later after my briefing. So while I do receive a lot of questions, yeah, a few questions from the participants during the registration asking what is transfer pricing, and they don't seem to know a brief understanding of what is transfer pricing. So with me going through into details of the requirements and what are the new changes, maybe just let me brief you through what is transfer pricing and who are the person that will fall into these transfer pricing provisions. So if you look at transfer pricing in Malaysia, it is where involved, yeah, related companies, or we call it as an associated person, yeah, that have transactions within the associated persons. Yeah, means if you have a transactions within your related parties or an associated person that we say we have control over the other company, yeah, that is where the transfer pricing provisions will come in place, yeah, because the scope of transfer pricing transactions will include, yeah, if you were to buy and sell any goods or services, yeah, or you provide any financial assistance, meaning the intercompany loans or advances, or you charge any transfer any intangibles, yeah, your trademarks, or you charge any royalty licensing fees, yeah, between your associated person, yeah, which is considered a related parties. So this will fall under transfer pricing, yeah, because the IRB wanted to see whether the transactions that you are transacting is at arm's length, whether you conduct, yeah, whether you transact the transactions between these two companies at an arm's length price, yeah, to ensure that there is no loss of revenue to the IRB, and the IRB also do not wish to see that you are transferring profit, yeah, from one company to the other companies. And under the transfer pricing law in Malaysia, sections 140 capital A of the Income Tax Act empowers the IRB to substitute the transfer prices unless the taxpayer is able to prove that the transactions are conducted at arm's length. Yeah, so you have to keep all these supporting documentations to prove to the IRB the pricing that you are transacting is at arm's length. Yeah, otherwise under this section 140 capital A, if the IRB deem that your transaction is not arm's length, they can substitute the price that they deem fit, yeah, to make adjustment to the transactions that you've entered into between your related parties. So if you have transactions with any third party customer, by all means, there is no transfer pricing issue, yeah, because that is dealing with willing buyer, willing seller, yeah, with third parties. But the transfer pricing issue only comes into place where you have transactions within your group of companies or within the related party, shareholders or directors. So the transfer pricing principle, the terms that we use in transfer pricing is the arm's length principle, meaning the arm's length price, yeah, is the price which would have been determined if such transactions were made between independent entities under the same and similar circumstances. Meaning if you were to sell a goods, yeah, to your related party, what is the pricing that you are selling? So will you be selling the same price to your third party's customers? So you have this type of comparison that you can make. So what the IRB will want you to justify is that the pricing that you are selling between your related parties is what that an independent party's transactions will be taking place. Yeah, that is where you need to prove that to the IRB. So let us look at the meaning of associated persons, yeah, because there are different definitions for tax purpose, for accounting purpose, and so forth. So for transfer pricing purpose, we look into these definitions, yeah, the meaning of associated person under sections 140 capital A sub 5, which mentions that the transactions, including the acquisitions or supply of property or services, yeah, any goods or services that you are transacting, or even financial assistance, which is your intercompany loan, yeah, between persons, one of whom has control over the other, individuals who are relative of each other, or persons both of whom are controlled by some other person. So if you fall under any of these category, you will be that person shall determine and apply the arm's length price for such acquisitions and supply because you are treated and considered as an associated person. Yeah. So just to break down into details, if you are a group of companies or a related companies or group of companies, yeah, you have a holding subsidy type of relationship and related companies relationship, and all these transactions will fall under associated person. Yeah, you will fall under the related transactions. Yeah, fall under the transfer pricing, and so long as your shareholding, yeah, is more than 20%, or you have control over the company's affair, yeah, you make decisions of the company's operations, or you have the right to remove, to appoint, yeah, the directors, yeah, one or more directors, yeah, within the board of directors, then you may be treated as having a control over the company. So a person takes control over the company through management control, share capital, voting rights, asset nominee, loan, creditors, etc. So even you are an individual, you can be a related person, yeah, to the company, yeah, if you have a management control over the company. Associated also includes husband, wife, parents, yeah, child, brother, sisters, partner. So if let's say your husband, yeah, the husband own company A and the brother own company B, and you have transaction between company A and B, this will be treated as under transfer pricing as well, yeah, because it's considered as a related party. So even though relative as well, yeah, parents, children, brother, uncle, sister, nephew, niece, yeah, if you fall under these definitions, also you will be treated as related party, or we call it as an associated person. Okay, so what is the transfer pricing compliance? So firstly, you need to determine whether your company fall under the transfer pricing provisions. If your company solely sell and purchase dealing with third-party transactions, you do not have this transfer pricing issue. Yeah, so first of all, you need to see whether you meet the first criteria. Then once you fall under these transfer pricing provisions, what are the compliance requirements that you need to be aware of? Yeah, who is liable to prepare a transfer pricing documentation? If any of the companies that undertake the control transactions in layman terms, we call it as a related party transactions. Yeah, this is the terms that we use in transfer pricing. So if any companies that undertake related party transactions, yeah, with your associated person that I've explained earlier, whether it is the sales, purchase of goods, services, intra-group financing, which is your intercompany loan, or use of any intangible properties, use of trademark, brand name, royalty, licensing fees, all these will fall under the related party transactions. Yeah, any companies that undertake these related party transactions, you have to determine what is the threshold. Yeah, a full documentations, a full transfer pricing documentation, in short, I call it as TPD, is required when a company has an annual gross income exceeding 25 million and total related party transactions exceeding 15 million per annum. This threshold is to assess on company level, yeah, not on a group level. So you need to assess each and every companies within your group to see whether that company exceed this threshold of gross income 25 million and the total related party transaction of more than 15 million. So if you have a sales, intercompany sales of about 10 million, and your intercompany purchases of another 10 million. So you have to total up all these transactions, sum up to 20 million, and you exceed that threshold. Okay, or if you were to assess your intercompany loan, yeah, your financial assistance, yeah, that exceeding 50 million, yeah, that will fall under the full scope. So whether your transaction is below the threshold or above the threshold, you still have to prepare the documentation. It's just a matter of what type of documentations that you need to prepare, whether is it a full scope or a limited scope. If your transaction is fall below this threshold, yeah, if your company fall below this threshold, you still have to prepare a documentation, but it's a limited documentation. Yeah, later on I will share with you what are the content and informations that you need to include in a full documentation versus a limited documentation. Yeah, so you know what you need to do, yeah, to comply with this requirement. Yeah, having said that, IRB does in their TP guideline, yeah, they do provide this so-called exemptions, person that can be exempted from preparing documentation. This exemption is only to exclude companies or individuals not to prepare documentation, but doesn't mean that you don't have to comply with the TP rules. You still have to comply with the TP rules, just that to save costs, yeah, in preparing this documentation, you can get some exemption, but you don't have to apply for that. Yeah, it's just for your own assessment. So who are the two categories that have these exemptions that do not need to prepare documentation? First is individuals that not carrying on a business. So if you are a director, you provide loan, yeah, you loan to your company, yeah, whether you charge interest or not, this individual, you do not need to prepare documentation because you are an individual that are not carrying on a business, then you don't have to prepare a TP documentation. Second is where companies, okay, you have to be careful on this second category of person. Companies involved in domestic control transactions where the parties are not enjoying tax incentive or not suffering any continual losses or is taxed at same rate. Yeah, and the effect of that transactions would not result in adjustment that will alter the total tax payable. So there are a lot of conditions under this second category. Meaning if you are transacting between two entities, company A and company B, these two companies are in Malaysia, paying the same corporate tax in Malaysia, and they are profitable. None of these two companies, they are not enjoying tax incentive, they are not making losses, and the adjustment, even if the IRB were to make adjustment, this adjustment will not alter the total tax payable of these two companies, then you can set aside not to prepare this documentation. Yeah, but you have to assess very carefully because any adjustment that the IRB make, if it will alter the total tax payable of these two entities, then you will get caught, yeah, on these conditions. Yeah, so this is also stated in the IRB guideline. Yeah, the duty to prepare documentations is to include all taxpayers who are involved in control transactions are generally required to maintain a contemporaneous TP documentations. These include taxpayers involved in domestic control transactions, yeah, where at least one party enjoy tax incentive, suffer losses, or tax at different rate, yeah, different corporate tax rate, or such that the effect of that transactions would result in adjustment that alter the total tax payable. So if you have two entities, one company is paying 24% tax rate, the other company is a SME, yeah, and is enjoying the 17% tax rate, then you probably can't apply these conditions, yeah, because the SME tax rate would be different, yeah. At first 500,000 or 600,000, you get to tax at 17%, yeah. So if any changes to the adjustment, it may have an impact, yeah, to the tax payable. So you have to assess your tax position before applying this second condition, yeah. And when to prepare this TP documentation. So in our guideline, we noticed that the IRB mentions contemporaneous TP documentation. A TP documentation should be prepared and is regarded as contemporaneous under the circumstances when at the time a person is developing or implementing any control transaction. So technically, before you enter into a control transactions, before you enter into a related party transaction, you should prepare this documentation to set up your transfer prices properly before you start charging your related party. Yeah, and on an annually basis, you need to conduct this annual review, yeah, of the existing documentations prior to the due date for filing of your tax return, which company we file Form C, yeah, for a year of assessment. So every year before you file your tax return, you need to have this annual review, or we call as an update, yeah, of your TP documentation to ensure that every year the company comply with the transfer pricing requirement in Malaysia. So I just give you an example. If your company is having a 31st December 2020 financial year end, your filing deadline for this year, because with the 2 months grace period that is being granted, your filing deadline is on 30th September 2021. Yeah, you still have 2 months to go. And you suppose, yeah, you should prepare your TP documentations before filing your tax return, because in your tax return, you need to declare whether you have prepared this TP documentation, yeah, in your Form C. So if you take yes, but in fact, you do not have a documentations ready, yeah, you have to be careful, because when IRB come for audit, they will request these documentations within 14 days. So usually for us to prepare a complete set of TP documentation, it will take few months, yeah. And we hardly, or we unlikely that we can complete this full set of documentation within 14 days. So if you take yes, very likely that the IRB may not grant you the extension of time, because you have already said that you have a documentation. So supposingly when IRB requests, you should be able to submit on time. Yeah, so this is the risk of that. And when do you need to prepare, yeah, to update the documentations, the informations in the documentations, in particular the financial data or the suitability of the comparable companies for the benchmarking purposes, have to be reviewed and updated every year, yeah, in order to comply with the arm's length principle reliably. So every year you need to ensure that the companies comply with the arm's length principle. So you need to update the figure, the financial data every year, yeah, because the financial data will change on a yearly basis. Yeah, and the company is required to update the full set of documentations together with a new search of the benchmarking study every 3 years. Yeah, so the IRB say that, okay, when you prepare a benchmarking study, yeah, you can make use of the same set of benchmarking study for the subsequent 2 years. Yeah, you just update the financial data. But this set of benchmarking, this set of comparables companies, you cannot be using that for more than 3 years. Yeah, you have to refresh the search, yeah, and see whether there are new companies coming into the market, yeah, as a comparables company, to make sure the benchmarking set that you make use of is the latest available data. Yeah, so I just give you an example. So if in year 2019, yeah, you prepare a TP documentation, yeah, with a new benchmarking analysis, so the subsequent year 2 and year 3, you can have an update of the documentation, which just to update the financial data, yeah, the financial update of the benchmarking analysis. Let's say you have selected 10 companies as your comparables. So you just update these 10 companies in your subsequent 2 years. But on the year 4 itself, you have to redo a new search, yeah, to ensure that the comparables companies that we have selected uh, are still acceptable, yeah, or if is there any new companies in the market that you should be adding on, yeah, to your comparable set. Yeah, so this is the 3-year cycle that the IRB practice, yeah, in this compliance. And what are the contents in a TP documentations that you should prepare? Yeah, a good quality TP documentations that complies with the Malaysia TP guideline, yeah, shall include the following. So there are a list of informations. Yeah, I've summarized the list of content informations from the guideline, yeah, to show you that to show you that what are the requirements and the contents that you need to include for a full documentation versus a limited documentation. Yeah. So for a full scope of documents, you need to document your group overview, yeah, your group structure, your group overview, your business operations, yeah, and the company background, your organization chart, your head count, yeah, and who are your customers, your major suppliers, and all the terms of sales and purchases, yeah, and you have to explain your supply chain, your business model, your product range or your services range in the report, yeah, as a full scope. This also apply to a limited documentation, yeah, to 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 explain, yeah, your company's overview, the background, history background of your companies as well as the group. And furthermore, you have to explain your control transactions, which is to the list of related party transactions that the company has entered into. What are the transactions? What are the nature of the transactions and who do you pay to? So you have to provide a list of that. Yeah, you transact with company ABCD and what are the breakdown of the amount. Yeah, and how is the pricing policy being charged? Yeah, how do you set up the pricing policy between the charging party, yeah, and uh, who any formula, yeah, that you have applied, whether you apply a cost plus markup method or you apply any pricing basis, or whether you make reference to any commodity price or market price, yeah, that the management has decided to set up this price. So how is this pricing basis being determined? So you have to explain this in the documentation as well, yeah, including a comparability study to ensure the correctness of the arm's length price. So if you are making reference to any market rate, yeah, you have to include that comparability study in the report, yeah, to justify that the transfer prices between the related parties is somehow make reference to some independent pricing, yeah, that you have transacting with. Yeah. For full report, you do have to include industry analysis. So if your company is in a property development, yeah, or property industry, so you have to analyze the industry of the property market during the period under review, yeah, to see whether your company performance is in accordance to the industry trend, yeah. And also the functional analysis, yeah, we call as a FAR, which represent the functions, asset, and risk analysis, meaning that what is the functions that performed by the companies, yeah, the departmental functions. You have a lot of departments within your firm, so you need to explain the functions that performed by all these departments, yeah, and what are the assets that employed by the company in carrying out its business operation, and what are the risks that the companies will bear, yeah. And this functional FAR analysis will help to characterize the company. So if you have a higher FAR profile, the RRB will seem that the company is performing more functions, taking a higher risk. So eventually this company could be earning a higher return, yeah, should be earning a higher return on that. But on the reverse side, if let's say you are just a limited risk entity, so the RIB would expect this type of limited risk entity to just earn a routine margin, yeah, with in their operations, yeah. So that characterization is very important because we do see RIB challenging on this characterization. Some company they characterize themselves as limited risk, yeah, but when it comes to audit, the RIB interview the departments, the HOD, and understand that they do a lot of functions and bear a lot of risk. So eventually the RIB may recharacterize the company to a full-fledged entity instead of a limited risk entity. So you have to be careful when it comes to this entity characterization as well. Yeah. So once you have characterized the entity as a full scope of documentations, you need to select and apply the TP methods. There are 5 transfer pricing methods in the transfer pricing rules, yeah, that we apply. So you have to select any one of these methods to apply to determine the arm's length price of your transactions, your related party transactions. And very often and not, we will perform a benchmarking study, yeah, to determine whether your profit margin that earned by the company fits into the arm's length range, yeah, based on the benchmarking result. That is where we will look for the comparables companies, which is your competitors in the market, yeah, in Malaysia, that are performing the similar type of activities, your business activities as your entity, and what are the profit margin that this group of competitors are earning as compared to your entity. So if your entity's earning is better than the comparables companies that we have selected, so the IRB would be satisfied with that, meaning that you are actually doing better or consistent with what the market is doing. Yeah, but if your margin fall below the range, yeah, the benchmarking range based on the study, then the IRB could challenge that whether your low margin is due to your related party transactions, that you try to transfer the profit to the other company, resulting in your entity recording a low margin. Yeah, that is where the IRB will look into different angle to see whether is there loss of revenue to the IRB by having this transfer prices with your related party. So lastly, we will have to analyze your financial analysis, yeah, to determine what is the financial ratio of the company, the profit margin, and if the company is making losses, you have to justify, put through the quantitative and qualitative justifications in the document, yeah, to explain what is the reason that the company is making losses. It could be due to the commercial reason, yeah, or due to your third-party transaction. And you have to demonstrate that the losses is not due to your related party transactions, yeah. So this is overall, the whole documentation is to support the company's related party transactions, to ensure that the companies comply with the arm's length principles of the transfer pricing rules in Malaysia. Of course, for a limited scope, you don't have to do so much of analysis, yeah, because your transactions is below the threshold. So not to burden so much of the company, the IRB say, okay, you can prepare a limited scope. Yeah, you don't have to do the rest of the analysis, the comprehensive analysis that require for a full TPD. So what are the latest changes on transfer pricing for that take effective from 1st January 2021? Okay, you have to take note of this. Starting from 1st January 2021, there's the introductions of new penalty under Section 113 capital B between 20,000 to 100,000 for company that fail to submit their TP documentations to the IRB on time. Yeah, so this new penalty is this is a new penalty that previously they do not have this penalty, meaning that previously if you do not prepare documentation, IRB has no right to penalize you. Penalty is only when they make adjustment. But now, even if there is no adjustment being made, but when they request for these TP documentations during a transfer pricing audit or during a normal corporate tax audit, if you couldn't furnish this documentation within 14 days, yeah, the IRB can impose this new penalty of 20,000 to 100,000, and this penalty is imposed on each year of assessment. Yeah, so you have to be careful. And the IRB has also updated the paragraph in TP guideline, yeah, to that the period to submit this documentation initially is 30 days, and now they have shortened it to 14 days, and we have been seeing IRB letters sending it over to our clients. I mean, recently, starting from this year, it has been effective with 14 days. Yeah, so yes, they are taking this action. Another new subsections 3C is the introductions of this new surcharge of not more than 5% on TP adjustment made during a TP audit, regardless whether the company is a tax payable positions or not tax payable position. So meaning that if the IRB were to make adjustment, yeah, if the company is making losses, yeah, the company may be able to utilize all their carry forward losses to this adjustment, and eventually they don't pay any tax. Yeah, so previous practice is that penalty is only imposed if there is any additional tax payable. Means the IRB make adjustment, and this adjustment give rise to additional tax payable, and penalty will only be imposed on this additional tax payable. Yeah, so if the company is enjoying tax incentive, maybe you have a pioneer status, yeah, any adjustment that made by the IRB, it is exempted from tax, yeah, you don't have to pay tax. So previously, all these company, they don't really care about transfer pricing because any adjustment made, there is no real tax impact, yeah, to the entity. So that is why the reason IRB has made the changes, yeah, on the penalty regime, yeah, to change the penalty rate on the previous rate to this new surcharge of 5%. So this 5% meaning 5% will be imposed on the actual transactions of adjustment, not on the additional tax. Yeah, let's say the IRB make 5 million of adjustment. This 5% will impose on the 5 million, yeah, not on the additional tax. So whether at the end of the day, you can utilize your tax losses or you are under a tax incentive company to utilize, to set off all these adjustments, you still have to pay the surcharge on the adjustment. So another subsections on 3A and 3B is to empower the IRB to disregard the structure in a control transactions and make transfer pricing adjustment to the structure that the IRB thinks fit. Yeah, so this is what has been explained just now. The IRB has the right to recharacterize your entity. Yeah, if during the audit they find that you did not characterize it properly, yeah, or the structure is not being set in a manner that what an independent arrangement would be dealing with. That's where the IRB has the power to disregard the structure, yeah, and make adjustment accordingly. Okay, lastly, the IRB has also updated in the TP guideline where penalties will not be imposed in cases where they have the company has a TP documentation is of good quality, means you fulfill all the contents that I mentioned just now, yeah, in accordance to the TP guideline. And upon request by the IRB, the company able to submit the TP documentations within 14 days. Yeah, so the IRB has stated this in their guideline. So to go into further details of each of these changes, yeah, just now we talked about section 113B on the failure to furnish contemporaneous TP documentations through IRB. So where no prosecutions, 20,000 to 100,000. Where there is a prosecutions on commissions means if your case went to court, yeah, then it will be liable to a fine of 20 to 100 or imprisonments of a terms of 6 months or both. Yeah, so these sections has eventually make these documentations become mandatory requirements for companies undertaking related party transactions. Yeah, and these documentations must be contemporaneous, means up to date, yeah, before you file your tax return, and should be readily available upon a request by the IRB during a tax audit. Yeah, although you prepare your documentations after your filing, after the filing of your tax return, that you still can do that. Yeah, so long as upon request by the IRB during a tax audit, you can submit these documents to the IRB within 14 days. Yeah, and penalty is imposed on each year of assessment. So if usually when IRB come for audit, they will not audit you for 1 year. Yeah, they will carry out the audit at least 3 years up to 5 years. Yeah, for transfer pricing audit, it can be up to 7 years maximum. Yeah, for normal corporate tax audit, it will be up to 5 years. Yeah, that's why usually the IRB will conduct an audit at least 3 years to 5 years or 6 years. Yeah, for transfer pricing audit. So if let's say they carry out for 3 years audit and you do not have documentation for all these 3 years, so they can impose a minimum 20,000 times 3, yeah, which is 60,000 on a minimum basis. So when will these sections take effective? Yeah, because a lot of people questioning the sections only introduced in implemented in 1st January. So and the TP audit that being carried out, it may not be on year 2021. Yeah, let's say the IRB send in a letter to request you to provide the TP documentation for year 2017 to 2019, which is prior to year 2021. Will this be applicable? Yeah, will these sections be applicable? Yeah, can these sections be applied retrospectively? So we see how the IRB practice on this. Yeah, so if your TP audit, yeah, conducted, means you receive the audit letter from the IRB. And in the audit letter, the request for this TP documentation is after 1st January. Yes, these sections will be applicable. Yeah, regardless whether the audit period year is for 2017, 18 or 19. So long as the audit is being conducted now, yeah, after 1st January, and the TP documentation requested after 1st January, it will apply this new section. Yeah. Even if your TP audit, yeah, you received the audit letter from IRB last year, but the IRB only requests the documentation this year. Yeah, it could be that situation we have seen. Yeah, and it will be applicable as well. Yeah, unless the audit and also the documentation was requested last year. Yeah, were requested last year and you only submit this year, then it is not applicable. Yeah, you will not fall under this section even you do not submit on time. Yeah, and if you were to apply any extension of time, IRB given you 14 days. You say, oh, 14 days is too short. Yeah, because of lockdown and all this, I couldn't access and all this. And you request for extension of time. IRB will agree with that. Yeah, usually they will grant another 2 weeks. Yeah, in total you have 1 month to prepare your documentation. So even if the IRB will clearly state in the audit letter, even though an extension of time is granted to the company, it will not, I mean, these sections will still be applicable. Yeah, the IRB may still have the right to impose a late filing of TP documentation because you couldn't meet the original deadline of 14 days. Yeah, even they have agreed to grant you the extension of time, right? So the second changes on 3A, 3B, where the power to disregard the structure in a control transactions and the IRB can make the TP adjustment. So I have explained that the IRB may disregard any structure in a control transactions and make adjustment on the structure if it thinks fit. Okay, if the IRB is of the view that the transactions, yeah, the economic substance of the transactions differs from the form, or the control transactions differ from commercially acceptable transactions undertaken by independent parties. I give you an example. Let's say you have a Malaysia entity, yeah, a subsidiary in Malaysia, and this company you characterize this company as a sales agent. Yeah, they are just helping to look for your customers, and then they earn the commissions as a sales agent. But in the accounts of this company, you have recognized the trading sales, yeah, because as a sales agent, you supposedly you should only earn the commission fees, yeah, or the agency fees. But this company has recorded the trading sales, yeah, in the Malaysia entity. So in that case, the form, yeah, the document that shows to the IRB, it differ from what has been transacted, yeah, and what has been characterized for the company. So in that case, the IRB may say that you doesn't seem to be like a sales agent because you are recognizing all the sales transactions, yeah, in your company. You are actually a trading company, a distributor in Malaysia instead of a sales agent. So in that case, the IRB would expect a trading company to earn a higher profit margin in Malaysia instead of a sales agent, yeah, because sales agent usually have lower margin as compared to a distributions or a trading arm, yeah. So that could be the case, yeah, that the IRB think that you have not correctly characterized your entity and they may recharacterize that, yeah. So the implications to the taxpayer is where when these recharacterizations of the business transactions take place, yeah, by the IRB, or the IRB may also reconstruct, yeah, the business structure, and this often give rise to significant tax costs to the taxpayer. Yeah, so this is a very big impact because now the IRB has the right to do that under this section. Yeah, they have the power to recharacterize the entity, yeah, to change the structure. Of course, we always argue that IRB, you cannot disturb how a businessman wanted to do their business, yeah. But eventually, if it is a control transaction, if it is a related party transaction within the group, then they have the right, yeah, under this power, under this section, sorry. So taxpayer would need to be extra vigilant, yeah, when adopting any transfer pricing structure. If you set up any transfer pricing structure or any planning, you have to be careful, yeah, that this structure are that commercially justifiable, and that the substance and the forms of the TP arrangements are aligned throughout the implementations period. So you have to do it properly. Okay, the third changes is the surcharge, yeah, that I explained, the 5% surcharge. So this surcharge is imposed on the amount of TP adjustment, not on the additional tax liability. And there will be a higher TP risk for non-taxable entities that are enjoying incentive or currently the company is having losses. So eventually this group of companies will have a higher TP risk. Yeah. And why the IRB has this surcharge and this new section is because the IRB wants to encourage TP compliance among all classes of a taxpayer, regardless whether you are a tax payable positions or you are a non-tax payable positions. All group of taxpayers should also comply with these TP requirements, yeah, not only tax payable company. And this 5% surcharge, as what we understand from the IRB, previously the penalty will be under section 113 sub 2, which is a 30% to 50% of penalty on additional tax liability. Yeah, and this penalty, as we understand from the IRB, was supposed to replace with this new surcharge of 5%. Yeah, so if the TP audit conducted prior to 1st January, then it will apply the previous penalty rate of 30 to 50% on additional tax payable. But if your TP audit is conducted starting from 1st January 2021, which is this year, then it will apply the 5% surcharge on TP adjustment. Yeah, and we are still waiting the IRB to update the transfer pricing audit framework, yeah, in the IRB website, because they're supposed to reflect these changes and clarify this penalty rate, yeah, in the TP audit framework, but it has not been published yet. Okay, this is in the Income Tax Act, yeah, under section sub 3C. Yeah, over here you can see that it mentions any person to pay a surcharge of not than 5%, and this surcharge is imposed on amount of increase of any income generally. So what it means under this section is that whether your income is a taxable income or is a exempt income, it can also subject to this 5% surcharge. For example, if let's say you are a pioneer status company, you enjoy incentive. So all your income that receive under the qualified activities are all exempted. Yeah. But if they make adjustment on these activities or on these transactions, that 5% surcharge, although your income is exempted, it may still subject to this 5% surcharge. So this 5% surcharge can be applied on any taxable income or exempt income. So you have to be careful on that. Not only taxable income will have this implication. Okay, and the timeline to submit the TP documentation has shortened from 30 days to 14 days. Yeah, for audit, TP audit cases commence after 1st January, all will be given this deadline. And if you couldn't submit within this deadline and you apply for extension of time, you may still be liable to this penalty under section 113B, which is the 20,000 to 100,000. So I would advise your company, if you have not done any TP documentation, please start now. Yeah, get ready your documentation, at least the first set of documentations to get ready and to ensure the annual update of your documentation, so that when IRB requests for that, you would be able to submit within 14 days, yeah, to reduce, yeah, the risk of being penalized under this new section. So circumstances where non-impositions of penalty. So briefly, I explain, if you prepare a good quality documentations and you submit within 14 days, the IRB has stated, yeah, in the guideline that there will not be any penalty imposed, but based on our experience with the IRB, most of the time there will be a penalty when they make adjustment, yeah, but at least you can negotiate, yeah, the penalty with the IRB. So just give a very simple example over here, the calculations of the new surcharge of the new penalty. let's say you have a parent company with a subsidiary in Malaysia. So this subsidiary company is making losses, yeah, loss-making company, and there is no local TP documentations prepared for year 2014 to 2019, where the IRB has commenced the audit on this year, yeah, 1st of March this year, and the audit period is 6 years from 2014 to 2019. And the TP adjustment made on the company is, let's say, 5 million. Yeah, they make adjustment. And with this 5 million adjustment, the subsidiary has no additional tax because they have a lot of carry forward business tax losses to utilize. Yeah, even after this adjustment being made. So the impact is that on the previous tax regime, there is no provisions in the law to impose surcharge or penalty for loss-making entity. So on the previous practice, you do not have any penalty made, even though they make a 5 million adjustment, there is no penalty, yeah, will be imposed on the company. But starting from this year onwards, with the new changes with the new sections that introduced, yeah, the 5% surcharge will be imposed on 5 million, which is the total adjustment, which can be up to 250,000. And if you fail to submit the documentation because you do not have a documentation for all these 6 years, so the penalty can be from 20 to 100,000 for 6 years of assessment. So it could be sum up to between 120,000 to 600,000. So this will be the tax exposure and the potential tax risk that the companies will have with this new tax regime. Okay, and some of the common TP issues, yeah, that we have encountered during our study with the companies and during our audit case, yeah, our transfer pricing audit with the IRB, yeah, we found that these are the common issue that most of the time the IRB will raise and may have a risk, yeah, on the company. So the risk factor that will trigger the transfer pricing audit from the IRB. So when we go through the common TP issue, first is that no charges for services rendered. So very often we see a group of companies, yeah, you provide services, you provide share services, or you support your subsidiaries within the group because the subsidiary is loss making. So that's why you don't charge the management fees or you don't charge over the cost because the subsidiary is making losses. So if you charge a cost to the subsidiary will be making even more losses. Yeah. So this could be one of the risk area, yeah, that can be challenged by the IRB, because if there is a services being rendered, the IRB will expect the service provider to charge the fees to the service recipients, whether the service recipients is a profitable or loss-making entity, because they do receive these services. So a lot of time we have seen companies not charging, there's no charges for services rendered between the related companies, yeah, within the group. And there's no proper pricing policy, no basis of charging. This is also very often that we have seen. We ask the client, how do you determine the price? Yeah, they always tell us, I have no idea, the management set the price. Or for example, like management fees, they just charge like 10,000 or 100,000 per month. And how do you set the price? No idea, it has been set since day one. So with all these reasons, it doesn't help the company to defend your position. Yeah, if the client, if the IRB were to challenge, because what the IRB wanted to see is that, can you explain how is the price being set, whether you apply a proper basis, a proper methodology, yeah, to set your price to ensure that it is not just plucked from the sky, or you charge any figure that you like, yeah, to adjust the margin of the company. So this is not what the IRB wanted to see. Yeah, so if you have a proper calculations, a proper basis and a formula, and you have the agreement to support all these transactions, then it will give you a stronger positions to argue and to negotiate with the IRB when it comes to a transfer pricing audit case. Yeah, and we have also seen companies charge to profitable companies and not to loss-making entity. Yeah, I've explained just now. Yeah, as IRB says that if the loss-making entity require these services, yeah, and if the loss-making entity were to engage a third-party consultant to do the work, the consultant would have charged them a fees, yeah? So you should not give that exemption because you are loss-making, that's why I don't charge you a fees. So this is not the proper way to do that. And reimbursement at cost without a profit markup. This is also very often that we have seen. Companies have a shared services. Yeah, you share staff, yeah, you have sharing of resources, and you just reimburse the cost without any markup. This has always been challenged by the IRB because how the IRB view that is that if you are a holding company and you have all your top management sitting at your holding company and you are providing services to support the whole subsidiaries, yeah, all the operations, the whole group business operation. So the IRB would view that this top management personnel, yeah, sitting under holding company, you are actually providing an intra-group services. So if you are providing a services to your service recipients, yeah, you should earn a margin. You should not be charging at cost. Just like, for example, if let's say the company were to engage consultant, let's say like Crow, yeah, you engage us to give an advice, yeah, to provide you with a transfer pricing study, yeah, we wouldn't charge you at our salary cost, yeah, we would charge you with a margin, a markup on our salary cost. So when we compare with this independent party, that is where the IRB view that there should be a profit margin to be charged on top of the cost instead of just reimbursement of cost. Of course, reimbursement, of course, in some circumstances, you can still apply. For example, if it is a pass-through cost, let's say you incurred some payment on behalf, yeah, you incur some, let's say, electricity, yeah, you are sitting in the same office, you pay on behalf electricity, and this electricity was charged by, let's say, TNB to you, and then you just reimburse as a pass-through cost, then you don't have to put a markup to that. But if there is a service elements that you have provided to your subsidiaries or within the group of companies, there should be a markup on the service element. Okay, so I hope I explained this well to you. And the next issue is where that no benchmarking to support the profit markup. So a lot of time we have seen companies charging, let's say, management fees. You just charge a fixed amount without any markup, and even you have a markup, there is no supporting. Yeah, we have seen companies charging management fees with, let's say, 50% markup, 60% markup. Yeah, because of they want to cap more profit under the service provider. So this is not the proper way to do. So any of the pricing that you set, it should come with the benchmarking to support the profit markup that you apply, yeah, in your transfer prices. Interest-free loan. Okay, this is also another very interesting transactions that a lot of time we have seen company providing loan or financial assistance since day one without any interest being charged. This has always been a very hot topic and adjustment being made by the IRB whenever there is a transfer pricing audit nowadays. Yeah, although even like director provide loan to the company, we have seen IRB making adjustment on the individual directors to impose a deemed interest. Yeah, and related companies within the group, you have the amount owing balances non-trade sitting in your balance sheet. Yeah, and you do not charge interest because it's stated in the audited accounts as a non-trade and it is interest-free, unsecured. Yeah, all this will trigger the IRB to make adjustment, yeah, to impose an interest on your intercompany loan. So if you have a significant amount owing sitting in the company in the balance sheet, please look into that. Yeah, I alert you again, please look into those balances. Yeah, try to minimize your amount owing balances if you do not want to trigger this these accumulated figures rolling forward, getting more and more significant, yeah, in the following year. So look into that. Yeah, if you can reduce the balances, it will be better, yeah, for you to do that. Otherwise, you have to charge interest on the balances, yeah, unless you can justify that the amount owing balances is not a loan, it's not advances, it is an equity. Yeah, that is another issue, but you have to look into this area. Yeah. And loss-making entity without commercial justification is also very risky. Currently, the audit cases that we are receiving from the IRB, most of them is because the companies are making losses. Yeah. So if the companies are making losses and you have significant related party transactions, you have a higher risk that being challenged by the IRB, that your loss-making position is derived from your related party transactions. So if you are making losses, of course, if we set aside 2020 and 2021 because of a pandemic, a lot of companies has been affected by this economy. That is on an exceptional basis. Yeah, that one we have to explain to the IRB. Yeah, and justify by providing all the figures. Yeah, to quantify that. But I'm talking about the previous year, prior to 2020, where the pandemic is not in place yet. Yeah, that's where if the company is making losses, you have to put through a strong justifications, your commercial justifications, whether you quantify that, yeah, qualitative justifications as well as quantitative justifications, yeah, to put through in the documentation to justify the reason for this loss making position. Yeah, and the next issue, contract versus actual conduct. Yeah, a lot of time we have seen contract has been entered into like 10 years ago. Yeah, but if we look at the actual transaction they are transacting, is not consistent with what has been documented in the contract. So a lot of time when IRB comes for audit, they will request for your agreement. Yeah, and they will also interview the company to see how is the transactions being carried out. So if your transaction, your actual conduct is not consistent with your contract, yeah, then it will trigger the IRB to questions further. Yeah, whether your contract, whether you are compliant, whether you charge, yeah, according to what has been stated in the contract. Okay, special price or discount given without justification. Yeah, I'm not saying that you cannot give discount to your related party. You can still give discount and discount, and very often that when you sell to related party, it could be lower than your third party. Yeah, so long as you can justify, yeah, the reason why you need to give a discount, yeah, or why there is a different pricing between the third party customers as well as your related parties. And last but not least, no supporting document. Yeah, because when come for audit, IRB will ask for a lot of supporting document. For example, if you were to pay any management fees to your related parties in overseas, and the amount is, let's say, very significant, you are paying like millions, yeah, to overseas holding company. So the IRB will very often ask for supporting document. Please show me and prove to me you receive services from your holding company in overseas. Any document, yeah, you can prove them, any reports, yeah, that issue from the overseas company to prove that you receive the services in Malaysia and you need these services that benefit your business operation in Malaysia in order for you to pay these management fees to the overseas company. So all these supporting documents, including your invoices, your agreements, yeah, all this you have to keep proper records, yeah, because this can be called for during a tax audit from the IRB. And lastly, I wanted to address on the transfer pricing risk that will trigger the IRB to audit on the company. Firstly, if the company has significant related party transactions, when we talk about significance, it could be in volume, it could be in the value of the transactions, or it could be the percentage of a related party transaction. We have received IRB letter to audit on one of our clients, and their revenue is only 1 million. Yeah, so we are kind of surprised. How come 1 million will trigger the IRB to come for audit? And the client is also very surprised. Yeah, that's why they do not prepare any documentations to support that. Yeah, the reason being because these transactions, even though the revenue is 1 million, but this revenue is 100% charged to its related companies. Yeah, so if your related party transaction is consists of a significant percentage, I would say more than 50%, yeah, you have to take notes, yeah, that it will trigger the IRB to look into that. Yeah, firstly is the transaction, the percentage of the transaction consists of more than 50% of your sales or your purchases, yeah, it could trigger their attention, or your transactions amount is significant. Yeah, although your transaction is more than 15 million as per the threshold set in the guideline, 15 million. So if your transaction exceeded that threshold, it will trigger the IRB, yeah, to look into your company as well. So information that disclosed in the Form C, because all your related party transactions amount will be disclosed in the Form C, yeah, including your loan, yeah, your advances, your loan will also be disclosed in the Form C, yeah. They will extract this information based on their big data system, yeah, to pick up the companies for audit. Financial performance, if you have fluctuations in your profit, losses, your profit or loss from year to year, yeah, this will trigger their attention. Low profit margin as well, yeah, if compared to the similar industry with a similar business code that you are using, yeah, if your margin seems to be at a lower range as compared to all the other companies that are using the same business code, yeah, because when you file your Form C, you have indicate what business code that you are in, yeah, and from their system, they will be able to see all this information. So persistent losses, yeah, if the company is having consistent or consecutive losses, yeah, throughout the years, then it will trigger the IRB to come for audit. And I would say a lot of time, we have been receiving letters for companies that are making losses. Yeah, tax holiday. If you enjoy any tax incentive, yeah, in the previous year, and suddenly after your incentive ended, yeah, expire, which is after the tax holiday, your profit margin have a sudden drop, yeah, after the tax holiday period. Means you may have shift your profit to the other countries, yeah, because you do not enjoy this incentive in Malaysia. This will trigger their attentions, yeah, to come for audit. Tax audit, if you are currently having any income desk audit or audit referrals from third-party informations, yes. Public sources, yeah, newspaper, if you are a public listed company, yeah, if you have some news coming from a public source, yeah, it may have, but usually this is not the main source lah, yeah, for them to pick up for audit. I think the main source is on top here, yeah, the top section. Tax haven, if you have trading with a entity in tax haven countries, yeah, then the IRB actually has a list of companies. Yeah, let's say you have they have a list of companies that have a setup in Labuan. Yeah, you have a Labuan entity set up. They do have a list of this company. And if you had a setup in like tax haven country like BBI, Cayman Island, yeah, they have all these lists. Yeah, just that whether your company will be picked up if you have significant transaction with these tax haven countries. And access payment, yeah, payment for intra-group services, very often we have seen if you have access payment to overseas, that will trigger their attention as well. Okay, so to summarize the key points, yeah, key takeaways for today's webinar, I would say on the latest changes, there are introductions of a new penalty, yeah, for failure to submit the TP documentations to the IRB on time, and the new surcharge of 5% that I explained, yeah, on the TP adjustment that made during a tax audit. And taxpayers should ensure that the entity is characterized appropriately from the TP perspective, not from the commercial perspective. It's from the TP perspective, and the TP structure adopted is commercially justifiable to avoid any dispute with the IRB. And for compliance purposes, yeah, and my last point will be the companies that undertake control transactions are required to prepare TP documentations, whether it is a full scope or limited scope contemporaneously, yeah, if you do not fall under the exemptions person. And taxpayer who prepare comprehensive and good quality documents and submit to the IRB within 14 days may request, yeah, upon request, may enjoy zero penalty as per the TP guideline. Yep. So I will end my briefing section here. So we'll move on to the Q&A sections. Yeah, how can we assist you before I go into a Q&A sections? So we do help our clients to ensure annual compliance of the TP documentations, yeah, to comply with the TP guideline. We ensure proper TP documentations in place upon request by the IRB, and prepare for any potential challenge by the IRB. We deal with IRB audit as well, and minimize the penalty on the TP adjustment by the IRB. So you can contact us, yeah, for your annual TP compliance update. And not only documentations, yeah, because we have a specialized team to provide a full range of services. We do provide transfer pricing advisory, planning, yeah, setting up pricing, and also transfer pricing dispute, and any advanced pricing agreement, any audit cases, investigation cases, we do handle that as well. And we have quite a number of articles, transfer pricing article. If you want to know more, you can go into our Crow website, yeah, to look for all these articles, yeah, or you can scan this QR code. So these are all available in our website, yeah, for some of these articles. And if you want to assess, yeah, how high is your transfer pricing risk for your entity, you can actually download or access to this assessment. It is free, yeah. You just need to fill up the questions in the form, and we will send you the assessment report, yeah, to see for your company with the information that provided to us, yeah, what will be your TP rates, whether you are at a high risk or you are at a lower risk or you are at a moderate risk of being audited by the IRB. Yeah, so we will analyze this we will provide you with this risk assessment report. Yeah, but you have to provide us those informations in the form, right? So you can access this TP assessment checklist, yeah, in our website as well. So let's move on to the Q&A questions. If you have any questions, you can post it in the chat box, but I will address some of these questions that have posted to me during the registrations. Yeah, during the registrations. Okay, questions 1. What is the positions of LHDN on interest-free intercompany loans? Yeah, IRB have said that if the company is charging interest-free, yeah, not charging any interest on the intercompany loan, this will not be considered as compliance with the transfer pricing rules in Malaysia. Yeah. So if you are providing any intercompany loan, the IRB would expect the company to charge an interest, yeah, to comply with the financial assistance, the transfer pricing rules in Malaysia. How to determine the percentage to charge to intercompany? Okay, this is not a straightforward answer, yeah, because to determine the percentage to charge, it depends on what type of transaction, firstly, yeah, and also you have to go through the analysis, yeah, as I explained just now, what you need to be included in a TP documentation. That includes, part of it is the benchmarking study. Yeah, so you need to carry out the benchmarking study to analyze to see what will be the arm's length rate that you can charge, yeah, according to the market rate. That's how you can set up your pricing appropriately. Yeah, so there is not to say, oh, you can charge 5%, 10%. There is no fixed rules, because different different transactions will have different terms and arrangement. Okay. Question 3, what is the best formula or standard to calculate or to set the management fees charged from holding company to subsidiaries companies? So I have prepared a slides to just summarize the step. This is a recommended or the preferred method by the IRB, which is a cost plus method. Yeah, so the IRB has also explained, yeah, in the guideline some of these applications. How can you charge for the intra-group services? So there are a simple 7-step approach in determining the arm's length intra-group service fees. Okay, step 1, you have to identify whether the services has been performed, yeah, and the type of services that you have been performed, whether you provide finance, HR, IT type of services, and the value of the services. Okay. Step 2, to identify the benefits of the service recipient. So if you provide these services to the service recipient, what are the benefits that received by service recipients? Yeah, it could be like saving their costs, yeah, for more operational efficiency. So these are the benefits, yeah, to the service recipient. Step 3, to identify and to exclude any non-chargeable services, for example, like shareholders' activities, duplicative services, services with incidental benefit, and on-call services. So when you determine your chargeable costs, not all costs can be charged. charge down to your subsidiaries. Yeah, you have to determine if, let's say, the cost fall under non-chargeable cost, then you can't charge down. Yeah, for example, shareholder cost. If you are a listed core, you incur all those AGM costs, yeah, the listing costs, all those you cannot charge out because that is a cost of a holding company. Yeah, and if you are having a duplicative services, if let's say, for example, the subsidiary have their own audit fees, yeah, and in that case, you probably cannot charge your audit fees to your subsidiary, yeah, because it's duplicative. So you have to identify the chargeable cost, yeah, to determine the share costs that you can charge down. And step 4, to calculate the pool of costs and to determine which cost to be charged, yeah. And step 5, to identify costs that could be charged directly and indirectly. Yeah, some costs you incurred solely for this subsidiary A. Yeah, then you can allocate directly to subsidiary A. But some of the cost is a common cost, or we call it as a share cost, that you can't allocate directly. It is a pool of a cost for the whole group of companies. Then you have to go for an indirect method. So for an indirect method, you have to apply an allocation key to charge the indirect cost. Yeah, the allocation key can be based on, let's say, like based on revenue. Yeah, you allocate the cost, or you based on number of head count to allocate the cost. Yeah, or you based on time spent, how much time you spend on company A, company B, company C to allocate the cost accordingly. So we call this as allocation keys. Yeah, so once you have determined your cost, your allocations key, that's where the last step is to determine the arm's length price by calculating an appropriate markup. So you have to apply a markup on the cost that you, the chargeable cost, yeah, that you have determined. So that's we call as a cost plus method. Questions 4, if the related party transaction is not disclosed in the audited financial statement due to materiality or etc., is it still expected to be included in the TP documentation? Answer is yes. You're supposed to include all the related party transactions, whether or not disclosed in the audited accounts. Of course, if the transaction is very minimal because it's not material, yeah, we usually will still disclose in the documentation, yeah, because when IRB comes for audit, they are not only looking into your audited accounts, yeah, they will look into your GL, your ledger, yeah, and they can find all these related party transaction, yeah, that you have transacted. Of course, if the amount is insignificant, they probably don't bother so much, yeah, because that doesn't give them a lot of adjustment on that. Questions 5, if the sales turnover of a company is below 1 million, does the company needs to prepare TPD? If it involves in charging management fees or licensing fees to related companies due to usage of its intellectual property rights, does this fall under transfer pricing and need to be disclosed in the TP documentation? Answer is yes, yeah, to both. So if your transaction is below or turnover is below 1 million, you just need to prepare the limited scope, yeah, the limited TP documentation. Question 6, what is the method to use in determining the transfer prices for a company subsidiary? Again, what method to use is depending on what transactions. And under transfer pricing, there are 5 methods. Yeah, we call as a transfer pricing methods. There are 5 methods over here. So cut method, the comparable uncontrolled price method, is where you can use this method to compare your pricing. Yeah, let's say you sell to your third party as compared to the price that you sell to related party, or if let's say it is a commodity product, yeah, you can make reference to some commodity market price. Yeah, so that is where you apply this cut method to compare your pricing. Yeah, this is one of the method. So they do have a resale price method to compare the gross profit margin. For example, you are a reseller, you buy from your related party and you buy from third party supplier and you sell to the customer. So what is the margin that you earn? Yeah, and cost plus method. Yeah, cost plus markup is you assess from the gross profit level as well. But usually these two methods we hardly use, yeah, because IRB prefer to assess from the net profit level instead of a gross profit level, because the view from IRB is that they will want to take in all the operating expenses that the company incurred Yeah, the reason being because a lot of the company when they recognize in their accounts, they tends the expenses they recognize tends to be could be different. Yeah, some companies they're taking cost under cost of sales, which is before gross profit level. Some company take on the cost after gross profit level. Yeah. So if you were to assess gross profit level with some other comparable company, somehow it may not be so accurate. Yeah, if the recognition is not consistent. Yeah, so that's why usually the IRB prefer the TNNM method. Yeah, which assess the net profit level where you have taken all your operating expenses. Yeah, and profit split method is also another method which is rarely used. That's where to see how much profit sharing. Yeah, the split ratio that should be earned. Yeah, by the related parties, but usually this method is very subjective and can be challenged by the IRB. So in most cases, the method that we'll use is the cut method or the TNNM method. So it depends on your transactions. Yeah. So question 7, is there any provisions or exemptions that the IRB will accept if a holding company waives the charging of interest on late payment of management fees? Okay. There are companies within the group, for example, may even have difficulties in paying the management fees. Okay, if you talk about waiving charges of interest on late payment of management fees, firstly, we have to see management fees usually is treated as a trade transactions. Yeah. So if you do not apply any late payment interest on your trade transactions, yeah, you can justify in the manner that you do not apply late payment interest on your management fees as well. Yeah. But there could be cases where in your accounts you recognize this as a non-trade amount owing balances and it is a long overdue in the accounts, then the IRB may treat this as advances, as in you are actually funding the company. Then there may be a interest, yeah, imposed on non-trade balances. Yeah, so if you are talking about interest, I would say in most cases there should not be late payment interest charge on the management fees. Yeah, but if you are talking about waiving the management fees, then I would say even though the company is loss making, there should not be any waiver. Yeah, you should also be charging unless the company is dormant. Yeah, otherwise there can be a risk that the IRB will make adjustment on that. Okay, questions 8, in complying with TP requirements, companies providing services to subsidiaries or affiliates are forced to charge management fees based on the industry benchmark markup for services provided. However, where subsidiaries are unable to pay due to non-profitable business, the fees accumulate and subsequently the holding company may need to write off the amount as bad debt. Yeah, and the cycle continues. Is there any way that this can be overcome? Okay, very good questions. Yeah, whereas same company in this situation, because RB said that, okay, loss-making company, you still have to charge so long as you receive the services. So if this continues, there could be a possibility that the holding company may need to write off the debt. So when you write off the debt, that's where you have another tax implications, yeah, on the bad debt written off, yeah, the tax impact on the bad debt written off. So any way to overcome this, I would say if you do it in a proper way, that is where how it goes. Yeah, but if you do not want, if you foresee that there is no way that the companies will pay back this, and to have this write-off bad debts, you can have another way, but there is way that the holding company, when you incur this cost, yeah, you still have to calculate this cost for, let's say, a subsidiary. But because this subsidiary couldn't pay, you know that this subsidiary couldn't pay you, and you choose not to charge them, in fact, as a holding company, you should not claim tax deduction on this cost. Yeah, because this cost is not incurred, for your company, it's incurred for your subsidiary. So if you do not want to charge that management fees, then technically you should not claim the cost, yeah, the tax deductions on the cost that incurred under the holding company. Yeah, so hope you understand where I'm coming from. So I've done with the questions that have been posted to me earlier. So
Yes.
we still have some time. Yeah.
Okay.
Shall we?
Thank you, Sylvia. Right. You've answered that. I've got a few more that just came in. All right. It's quite insightful. And from my years of experience before as a corporate accountant, It's truly quite getting more and more complicated. We used to do a lot of HQ management fees, recharges, and stuff like
Yes.
that. And it's getting a bit beyond. And again, own company or groups strategies and stuff like that are now being scrutinized by the IRB. So it's getting a bit tougher. So we have to be, as I think the takeaway here would be that you need to be a bit more cognizant of certain risks that you might expose yourself. Okay. Okay, there was a question, I think we got to do with your summary. Okay. One Miss Wong Xiao Li, she was asking the definition of ensure entity is characterized appropriately from the TP perspective. Can you elaborate on that? What does it really mean?
Okay. When we talk about entity characterization, just now I've given an example. Okay, for example, okay, I thought about a manufacturing company. Okay.
How you treat the revenue.
Correct. So manufacturing companies, generally there are three characterizations. It could be a full-fledged manufacturer, means you provide your manufacturing process from A to zero. You carry out the purchasing of all your raw material, you do the productions, and then you sell. You have a sales team to look for sales and sell to the customers. So this we call as a full-fledged manufacturer. Or you could be a contract manufacturer. Means you are dealing with your principal. You still have your procurements of all your raw material, you do the productions, but you don't have to look for your customers. Your customer is just the principal that you'll be selling to your principal. So you are acting like a contract manufacturer. Or it could be another situation that you are a toll manufacturer. Means you don't purchase any raw material. All the raw material, the asset are all provided by your holding company. You just provide the production services, and then you just charge your toll services, tolling manufacturing services to your holding company. So when you characterize your company, you need to characterize whether you are a full-fledged, you are a contract manufacturer, or you are a toll manufacturing. Similar to a distributor. You can be a full-fledged distributor, or you can be a limited risk distributor. So why this is important is because when IRB assess the profitability of the company, this will go in line with your FAR profile. So if a company performing more functions and taking on more risk, eventually the IRB will expect this company to have higher profit margin. As compared to a limited company. A limited risk distributor, let's say I say limited risk distributor, you just have a sales team, to sell the goods. You don't bear a lot of risk. Any of the risk relating to the product, you will just pass back to the manufacturer to deal with that. The defect goods or whatever. So your risk is very minimal. You just deal with the trading sales. So like this limited risk distributor, the IRB will expect, okay, this kind of limited risk entity, usually they should have retained their routine return. They may not have a very high profit margin because you don't do a lot of functions. And you don't bear a lot of risk. This limited risk entity will just have their routine margin. Let's say maybe like 5%, routine margin, and their margin is quite consistent. Whether the holding company, when they sell, whether they earn high margin or they make losses, you should be getting your routine margin. So that is the view from the IRB. But of course, we have raised this issue to the IRB that during this pandemic year, they can't expect a routine margin for this type of low risk, limited risk entity, because the whole supply chain could be making losses. So if let's say the whole supply chain is making losses, you cannot force the limited risk entity to make their routine margin. This is because limited risk entity, they still have a risk. They are not zero risk. So that have to be justified, if the company is making losses. So that's why I say this entity characterization is important, because once you have wrongly characterized and IRB has a different view, they can recharacterize your entity and to impose a higher profit margin that they think the company should earn.
Okay, that's quite good. Great. You're talking about risk. Okay, here's something which is quite prevalent. There's quite a lot of these things too. And it also ties in with Gwendolyn's question. As a holding company, sometimes you are more financially stronger than, let's say, some of the subsidiaries, and you provide guarantees for performance guarantees and stuff like that. Other than you recharging the fees charged by the bank, there's an element of risk. So it is about how would a holding company sort of, because it's, how do I calculate risk and pass it on to an intern?
Yes, very good questions, Sean. You have raised the complicated questions to me, but yeah, I would say it is very practical, yeah, especially for a group of companies. We have seen company providing, especially like holding and subsidy company, yeah, you need to have your loan from bank, and your subsidiary couldn't have that credit rating. That's why you need a guarantee from the holding company. So a lot of time we have seen holding company may be providing corporate guarantee, yeah, to the subsidiary. So as the definitions of the financial assistant includes corporate guarantee, yeah, meaning that when a company provide corporate guarantee to its subsidiaries, yeah, technically from the TP guideline, the IRB would expect an interest or a guarantee fees, yeah, to be charged. So for example, if let's say one of the simpler approach, I mean to explain this in a more simpler manner for your understanding. So for example, if a subsidiaries were to get a loan from the bank, yeah, bank say, okay, without any guarantee, I will charge you 12%. But if with your corporate guarantee, I charge you, let's say, 5%. Yeah, so you have a saving of 7% over there. Yeah, with corporate guarantee and without corporate guarantee. So with that 7% of saving, you should pay a partial of this 7% to the holding company as their corporate guarantee benefit, yeah, to the subsidiary. But of course, when looking into corporate guarantee, we have to see whether is there a real benefit that the subsidiary is receiving. So in my example just now, we can see a real benefit, yeah, with a corporate guarantee or without corporate guarantee. But there could be situations that it is the corporate guarantee is not to have a lower interest rate. It's just because you are part of the group and the bank need the holding company to be the some sort of a guarantor to approve this loan. So in that case, if you do not receive this, if the subsidiary doesn't have the benefit, yeah, of getting this corporate guarantee, I would say that probably you can may not need to have a charge to that because you don't have a real benefit to that. Yeah, but in our experience with the IRB, we hardly see IRB making adjustment on corporate guarantee. I wouldn't say they will not make. Yeah, it is in the rules, in the guideline that they have the right to make adjustment. But based on the audit cases that we have experienced so far, IRB rarely raise these questions, yeah, to make adjustment on corporate guarantee. Firstly, because there is no proper guidance in the IRB guideline on how to determine the guarantee fees. Yeah, whether is it 1%, 2%, yeah, or what is the rate to determine. IRB doesn't have given any proper guideline to determine that. So it's a very a subjective topic as well. Yeah, how the IRB can make adjustment on it. Yeah, so I would say, yeah.
Okay. I guess that I don't want to prolong this discussion. It's more towards having a consultation with Crow Tax.
Yeah, sure.
Things, we can go on to things like reputation. How much can I charge for reputation? Things like in the franchise world where you use my name, you're associated with me. How do I recharge? There's a risk to me in reputation.
Yeah,
okay, but this is something they can engage you to discuss.
Yeah, sure. Another, this is also another complex transactions, yeah, that we talk about royalty, where you have this royalty, these trademarks that come in place.
Correct.
That is where that you have to go through the analysis to determine in the market what will be the arm's length percentage rate that most of this royalty agreement would charge, yeah, in a franchising arrangement with the party.
All right. One more. Okay, a few more right here.
And sure.
Timelines for your submissions. You're saying that there are timelines and the penalties now for late submission and stuff like that. But management recharges sometimes includes costs that are, maybe annual or quarterly, or sometimes they got to be washed up with, dependent on some other outcomes before they realize it. Is it okay to do a estimate, and is this review, would be this be viewed by IRB negatively?
Okay, I think when you talk about the management fees charge, yeah, whether can this be charged based on the estimated amount, yeah, instead of having to calculate the actual cost, yeah. I think practically, yeah, how it works is that of course, when IRB assess, they are not assessing your current year. So when they are assessing for previous year. Yeah, once you have done all these transactions, they come in and assess for your previous year. So what the IRB is looking at is, of course, on the actual cost incurred. But we know that sometimes it's not practical to have an actual cost, because when you close your account, unless you do it on every month, you need to wait until you close your accounts, you have your actual cost to calculate. So some of the group, how they did it is because their group is very big, they have a lot of costs, a lot of companies to charge, so you need time to do all the calculation. So it can be, I mean, for management fees, you can charge on monthly, quarterly, yearly, or half yearly. Yeah, that is fine. Yeah, there is no fixed rules to that. And how to determine the calculations, if you do not want to base on a monthly actual cost, you can actually take in your previous year cost. Let's say your previous year you have incurred, let's say 5 million cost. You can base on this cost to estimate what will be your management fees charge for the following year. Yeah, which is a following year, and you can I mean, divide it, maybe you charge across 12 months or quarterly, yeah, or yearly, it's up to you, yeah. But at the end of the following year, you have to recalculate and assess whether your actual cost versus your estimated cost, yeah, because that could be a very much difference, yeah, for your cost incurred during the year. So if there is a variance, then you have to rectify that and make that actual calculations at the end of the year.
Right, that's quite good. Last one here, I think it has been addressed. It's saying here that if a company, this is from Ong Su Ping, if a company less than 15 million annual transactions, and annual revenues, I guess. But both companies, the related companies, enjoy the same rate. I presume it's IRB rate. Okay. Can the TP document be exempt?
Okay, as I addressed just now, there are a few conditions you will have to fulfill, yeah, in order not to prepare this TP documentation. Yeah, if you say that your transaction is below the threshold, yeah, and both companies are paying the same tax rate. Firstly, are you solely transacting between these two companies? Yeah, whether you do have transactions with other entities, yeah, because other entities' tax position could be different. So I assume your transaction is just A and B, and A and B are paying same tax rate in Malaysia. Yeah, it's a domestic transaction and paying same tax rate. And you also have to see if, let's say, any adjustment made by the IRB, would it alter any the total tax payable. If let's say the IRB make adjustment on company A, yeah, let's say management fees imposed on company A, yeah, let's say you did not put a markup to that, so they mark up, let's say 5%, so they make adjustment and adjust on company A and brought to tax. And this management fees is deductible, yeah, under company B, so there is no tax impact. So on that, you can justify that, okay, with all this put in place, and the company is not making losses, not enjoying incentive, and even any adjustment made by the IRB that doesn't alter the total tax payable of the company, then you can be exempted, yeah, from preparing the TP documentation. But the risk is that if let's say the adjustment made by the IRB will alter the tax payable, I give you a very practical example, interest income. Let's say company A provide loans to company B and does not impose interest free. And IRB comes and make adjustment, say, hey, you have to impose interest on your intercompany loan, and I'm imposing, let's say, 5% interest. So this 5% interest, it will be a deemed interest income on company A, and this deemed interest income will be fully taxable. Yeah, on company B as an interest expense, as you know, that interest expense may or may not be fully taxable because it could be subject to interest restrictions, or you have other interest restriction rules that need to apply that cause the company B may not be fully deductible on this interest expense. Yeah, so in that case, if one company is fully taxable, the other company is not fully deductible, then it will alter the total tax payable of the company. Then you will not be able to fall under this exemption. So that's why I say it's a bit difficult to justify now, because you wouldn't know what are the adjustments that will be made by the IRB. Yeah, you will only know after the IRB come for audit and come up with all the audit findings. So
right,
I hope I answered that questions. Yeah.
Yeah, okay. So it has been a really, really insightful webinar series. And as always, Crow has stepped up to the mark. And this is several already we have conducted. So for those that are watching us, either on Facebook Live or on Zoom, look out for more to come, as there are much more series sharing will be forthcoming. Okay, sorry, I just mixed up a bit. Okay, without further ado, I mean, we don't have any more extra questions. Before we wrap up, Sylvia, any last takeaways?
Oh, I
just
think,
be prepared lah.
yeah, just be prepared. Yeah, and please get ready your documentations. You can do it in-house on yourself, not necessary to engage consultant. Yeah, if you have the people, the knowledge to do that. But please get ready that if you need our assistance, please feel free to contact us. If we do not address all your questions that you have raised in Facebook or in Zoom, you can drop me an email, yeah, on any further questions that you want to clarify, or give me a call. Yeah. So thank you for your time.
There is a question about sharing of these slides that you give a presentation, so we can work something out for the audience, right? I guess.
Yeah, can, no problem. Yeah, we can.
Okay.
Yeah.
All right. Okay. Thank you very much for gracing our session, and thank you very much to also the audience for being patient in going through this. Wow, almost an hour and more than that. It's almost 2 hours, which is pretty good. Okay. See you guys. Stay safe and just be strong and continue. There's light at the end of the tunnel. Do not despair. Huh? Okay.
Stay safe,
Bye.
everyone. Take care. Bye. Thanks, Sean. Thanks.